So there are a couple of other things that you're dealing with. You mentioned two other things specifically, and these do apply directly to banks and to borrowers. One is restructuring and one is a turnaround. So tell me something about restructuring in this context, and then we'll talk about turnarounds.
So restructuring, I always encourage banks before they go for the extreme measure of receivership or foreclosure to talk to their borrower. It is a very easy thing to do. You get a pre-negotiation letter in place. You may even get some sort of releases and waivers as part of that pre-negotiation letter. And you can work with, there are a lot of professionals out there, whether they be lawyers or accountants or other turnaround specialists or restructuring specialists. And you can talk to your borrower, see what their cash flow is, see what their P&L looks like, see what their balance sheet looks like, see what their projected revenue is. And you can sometimes right size a loan or right size a loan payment or modify that loan for the short term, for the long term, et cetera. So from a bank's perspective, there are more options out there than just foreclosing and receivership. The real problem I found in the Great Recession was those 90 days that we talked about earlier. Is it wasn't enough time to negotiate that right size of a loan. But now that we're kind of like on pause, I actually think now is a good time for banks to talk to their borrowers and restructure those loans or restructure those obligations.
Richard, they're allowed to do that? They are allowed to do that? They're
allowed to do that. They if they get a pre-negotiation letter in place, they're actually encouraged to do that in some instances.
So they could say in theory, they could say we're going to pause loan payments for 3 months and add it to the principal, for example.
Right. Exactly. I just did a deal like that last week. I spent, in essence, 24 hours without sleep rewriting a loan and right-sizing it for a borrower on behalf of a special servicer. So there are ways to do this, and there are ways to make sense of it. The other thing, though, that borrower has to do, they have to make a commitment not just to renegotiate with the bank, but to renegotiate with all their creditors. And in those instances, there are turnaround specialists, chief restructuring officers, et cetera, that are very well trained in how to deal with those situations. And they usually have a carrot and a stick, or they speak softly and carry a big stick, to quote Teddy Roosevelt. And they're able usually to create a cash flow, maximize cash flow, so that the secured lenders in those circumstances can get their due based on whatever they renegotiated. A turnaround is a little bit different. Turnaround, dovetails into actual insolvency, and you have a lot of different ways that you can skin that cat. You can do a turnaround by renegotiating your obligations, getting them to be lower payments, but a lot of times that is ineffective for some businesses, or there's a knock-on effect or a domino effect where if you cut off your vendor, then your vendor doesn't have enough cash flow to provide the goods and services that you need from them to keep your business going. So there can be these consequences that are unintended or unpredictable. So in a turnaround situation, you try to take all those things into consideration, and you have multiple tools to do that. Some legal, some practical. The practical is like going out and negotiating with folks and figuring out where those sensitivities are. But then you have things like insolvency, like a Chapter 11, where you actually go and you restructure debt with a court officer or the U.S. Trustee's office overseeing that restructuring, and you put together a plan that the creditors have to approve and everything else. I'm not a big fan of bankruptcies because I always think they take too long and cost way too much. But it is it is an option out there for businesses that need to absolutely restructure from top to bottom.